They are guaranteed a lifetime income stream no matter how long you live. You get this is essentially like a personal pension plan. These income annuities are referred to in many ways: life annuities, income annuities, single premium immediate annuities, payout annuities. They all do the same thing though. They pay you a check every month for as long as you live. And typically what they do is they involve large insurers pooling people with similar age, gender into groups and calculating that and comparing that against the mortality tables and coming up with a lifetime payment schedule. And those who die before reaching their life expectancy are insuring basically those who live beyond their life expectancy. However, we have several ways for the annuitants to make sure, even if they die very early in the life of the contract, or someone in their family or someone that they designate will get that money that they put in there. The risk of outliving your income is pooled among all purchasers, and that's the law of large numbers that works and has worked so well with the life insurers. Here's a chart in the Babel report over the long odds of living. So essentially, a male who's healthy at age 65 has a 50% chance of living beyond 85 and a 25% chance of living beyond 92. A female who's healthy at age 65 has a 50% chance of living beyond 88 and a 25% chance of living beyond 94. And look at the couple. If they're both healthy at age 65, there's a 25% chance that one of them will be living beyond age 97. Now, folks, you need to think about this. Your nest egg may have to last you 32 years. And do you think really having it in the volatility of the stock market is going to make that? Most people don't think so. So here are the report's recommendations. Number one, you should begin annuitizing enough of your assets so you can provide for 100% of your minimal acceptable level of retirement income. Typically, that's a substantial portion of your nest egg. But remember, what you're doing is taking a risky investment nest egg and turning it into a guaranteed lifetime income. Annuitization provides the only viable way to achieve security without spending a lot more money. The economic models invariably attest to this, and the basic expenses far exceeds the potential upside of taking on additional equity risk exposure. So you'll generally need to annuitize a significant portion of your remaining wealth, but remember, you're turning that into a guaranteed lifetime income, so that should be something that makes you happy. But what you have left, you can invest in stocks, fixed income securities, money markets, those types of things. We even have other annuities that can grow when the market goes up and protect your principal and interest gained if the market goes down. They're a tremendous product and very popular. Economic models show that equities and fixed income are not substitutes for annuities because they do not address the major risk we face of outliving our assets. For this reason, economists generally consider life annuities to be an entirely separate asset class. Equities and fixed income can be complements to, but cannot replicate nor substitute for annuitization. So how much wealth should you put into your annuities? Well, you're going to want to make sure that your basic expenses are covered for every month, and then you're going to want to make provisions for extraordinary expenses like uncovered health care costs and institutional care. You'll want to make provisions for your heirs, but balance this provision against your own desire to live above your acceptable living standard. In other words, take care of yourself first and let your children worry about making their own nest eggs. Now, the greater tolerance you have for risk, the higher proportion of your excess, and I repeat, excess assets could be placed in stock or other risky investments. The study never found this level to be much above half of the excess assets. Remember, these generalizations, and they are generalizations, depend upon the size of the bequest as well as a host of other financial assumptions. A lot of market participants believe that stocks for the long run is the way to go. The study showed, though, that over the long haul, unless stocks achieved excess way above treasury bonds, at least twice as high as they're generally expected to generate, it often makes more sense to annuitize most of one's wealth at retirement. And building a retirement nest egg in your IRA or 401k is a lot harder than it might look. Many advisors recommend investing in mutual funds for the long term, but according to John Bogle, he's the founder of the Vanguard Group and widely considered by many to be the father of the modern mutual fund, the average equity mutual fund investor averaged only a 2.6% annual return between 1984 and 2002, while the S&P 500 averaged over a 12% return. Now take a look at this chart. The bar on the left side is a Standard & Poor's 500 and what it did over the period. And take a look at that little bar on the right-hand side, and that's what the average equity fund investor got. That's just unbelievable, isn't it? Well, no wonder Mr. Bogle is so upset about it. He wrote a scathing article called The Emperor's New Mutual Funds, and that report is available. And if you want it, just let us know. Email me at randy@mckeycompanies.com. A few other bits from the report. Older people earn less annual returns than even investors in the same markets. And one question you need to ask yourself, is it better to leave your funds in the hands of experienced professionals, especially when they have contractual requirement and have lots of experience delivering the product just as you've ordered it? Or is it better to leave your funds in your hands and the hands of the mutual fund salesperson? Neither of you are probably qualified to be pension fund managers, and so that should be a pretty easy decision. Remember, the greatest economic risk you face today is that you will live longer than your income stream. Sometimes we pay a very high price for maintaining what we think is control. So here's the conclusion. When considering the list of positive attributes with life annuities, guaranteed lifetime permanent income, you can't outlive it and it's guaranteed for your lifetime. It's a very low cost of doing business this way. You have access to invested capital at the same time, and you have inflation adjustments. You have legacy benefits. So when you put all these factors together, the argument for this income solution is compelling, and there's nothing else out there that can replace it. So thanks for watching today's educational video. I hope it added value to your life. Please let me know if I can provide more information or guidance with your important financial decisions. Here is my contact information. You can email me at randy@mckeycompanies.com, and please check out our other fantastic resources, mckeycompanies.com, retiredsafely.com, and then perfectstormshelter.com. Again, thank you for watching the video today, and please contact us if we can give you any more information that will enhance your life. Take care.